My name is Joe Ely. I'm a registered rep at Lightspeed Trading. Just wanted to welcome everyone for joining us today. I hope everyone can hear me clearly and see the slide. You're here today to participate in the free webinar, How the Tax Cuts and Job Act Impacts Investors, Traders, and Investment Managers. The presenter is Robert A. Green, CPA. He's going to get started in just a minute. But before we do that, I have a quick disclaimer that I need to read to you. This presentation is for informational purposes only. Nothing presented today should be construed as investment advice or a recommendation to buy, sell, or hold any specific securities. Since we don't know everyone's investment objectives or risk tolerance, we are not endorsing any specific trading strategies. Lightspeed Trading, LLC, is not affiliated with these service providers. Data, information, and material, the content, is provided for informational and educational purposes only. This content neither is nor should be construed as an offer, solicitation, or recommended to buy or sell any securities. Any investment decisions made by the user through the use of such content is solely based on the user's independent analysis, taking into consideration your financial circumstances, investment objectives, and risk tolerance. Lightspeed does not endorse, offer, or recommend any of these services provided by any of the above service providers, and any service used to execute any trading strategies are solely based on the independent analysis of the user. With that, I'm going to turn over the mic and we will begin our presentation. Thanks for joining us, everyone.
Hi, everyone. I'm Robert Green. Thank you, Joe. Let's get started. Let me just minimize the session here. Today's session is How the Tax Cuts and Jobs Act Impacts Investors, Traders, and Investment Managers, hosted by Lightspeed Trading. Thank you. I'm the presenter, Robert A. Green, CPA. I'm managing member of G&M Trader Tax. That's Green, Neuschwander, and Manning, LLC, our CPA firm, and CEO of Green Trader Tax, our website. We cater to traders and investment managers, tax and accounting firm, and our website gives all the information you need. We focus on traders because trading is a real profession, and other tax professionals and solution providers underserve them. Traders deserve tax advice from CPAs and tax attorneys who are acutely aware of different tax laws and regulations that apply to them. A lot of your local CPAs may not be on top of your needs. I'm a leading authority on trader tax and the author of Green's 2018 Trader Tax Guide, published every year since 1997. The 2018 edition was published in the middle of January. It includes the Tax Cuts and Jobs Act, impact on investors, traders, and investment managers. Today's content is covered in the guide in a much more in-depth manner. I'm also a contributor to Forbes.com, and I have content on leading brokerage firms and financial media, and frequently interviewed in all the leading media, Barron's, New York Times, Wall Street Journal, and the various television. And you'll see me at the Traders Expo at the end of February 26th in New York City. This information is educational. It's not intended to be a substitute for specific individualized tax advice. I encourage you to get that advice. I'm not affiliated with Lightspeed Trading. We're a CPA firm. They're a brokerage firm. So these are the main points that we're going to cover today in the Tax Cuts and Jobs Act. It impacts investors in many ways, some negative and others positive. So you want to know what the negatives are, try to avoid them, and try to enhance the positives. Investors with significant investment expenses like stock borrow fees, investment advisory fees, seminars, education, they're going to decry the fact that there's a suspension of miscellaneous itemized deductions, which include investment expenses. So in the past, you couldn't deduct education. That was not allowed as an investment expense. And there were various investment expenses you could deduct in excess of 2% of adjusted gross income. But now, starting in 2018, you can't deduct investment expenses at all. So you want to know, what can you do about it? Next, traders that are eligible for trader tax status, that's the business expense treatment, and investment managers who also have a business treatment, managing other people's money, they're considering a restructuring of their business for 2018 to take maximum advantage of the new tax law. Two tax benefits catch their eye. The 20% deduction on pass-through qualified business income, QBI. That's all your pass-through companies, your partnerships, your S-Corps, where you can get a business deduction. It's not a business deduction. It's not an AGI deduction. It's not an itemized deduction. It's something in between. It is below the adjusted gross income line, but it's a nice big deduction that you might qualify for. It's very confusing, and it's very limited, especially for service companies, including traders. Now, on the other hand, the big news in the act for business is the new C-Corp corporate tax rate, the 21% flat tax rate, down from a rate of 35%, graduated rates 15% to 35%. So a lot of corporations are paying much less tax. You traders know that because it's been part of the reason the markets have gone up, because corporations are saving money from paying taxes and using it for buybacks, investment, job creation, raises, bonuses. So you've been benefiting from that as an investor. Well, can you benefit on using a C-Corp in your life too, for your trading activity, for investing, for another business that you have, for a spousal business? So should you consider the C-Corp? Should you consider the pass-through deduction instead? A lot of people are calling their accountants now saying, what do I need to do to maximize my benefits? I don't want to miss the boat. Now, as a third bullet point today, we're going to talk about the fact that the new law suspended or trimmed several cherished tax deductions that individuals count on for savings. Like that SALT deduction is capped. Other deductions are just flat out suspended, like miscellaneous itemized deductions, including unreimbursed employee business expenses, tax compliance, investment expenses. So exactly how bad is it, and what can you do about it? There are some things that you can do about it. Like, for example, trader tax status gives you business expense treatment. So let's start with the first section for investors, where there's negative and positive impact from the new tax act. So remember, as you prepare your 2017 tax returns, you're not focused on the tax changes in the new tax law, because they, for the most part, take effect in 2018. So you want to apply the prior law to 2017. Now, if you want some tips on preparing your 2017 tax return, look at the webinar recording that I did for Lightspeed last year with the 7 tips. They have it on their website. A lot of people still use it. The 2017 tax law is mostly unchanged from 2016. So what I told you as tips for 2016 tax return preparation, you can use for 2017. So I suggested to Lightspeed that this year I focus more about the changes for 2018 for purposes of planning, because there's a lot you need to do in advance to get these benefits. For example, if you want a pass-through entity and get that 20% pass-through deduction, you got to set up the entity now. You can't set it up at year end. So let's focus on the investor changes first. Investment expenses are suspended. What do I mean by suspended? That means that they're suspended for 2018 through 2025. In 2026, they come back to the old law. That's because Congress did not have enough room in the budget deficit that they approved $1.5 trillion of deficit for the tax cuts. They would have blown a hole in that had they made it permanent. So they made the C-Corp tax rates permanent, but a lot of the changes for individuals are temporary. And they need that 10-year bird rule, and they had to even go shorter than that. And they timed it for the elections in 2026. They presume that Democrats will help renew or make permanent the individual tax changes, although some they may not be like the SALT deduction, and maybe Democrats won't want to renew them. So the new law suspends all miscellaneous itemized deductions that are subject to the 2% floor under present law. These include investment expenses. So if you have miscellaneous itemized deductions on Schedule A, first you look at what's your adjusted gross income. Let's say it's $100,000. Well, 2% of that is $2,000. So you need $2,010 to be able to deduct $10 because the first $2,000 is the floor. Now, as many of you probably know, there are other limitations as well. Let's say you make it through that first limitation for 017. Then it's miscellaneous itemized deductions are not deductible for alternative minimum tax. So if you're an upper income taxpayer paying AMT, you won't even get this deduction. And if you're a real upper income taxpayer, there's also a piece itemized deduction limitation. Well, Congress kind of changed all that for 2018. They said they wanted to repeal or suspend AMT, which they ultimately were unable to do, although they did raise the exemption on AMT. So AMT still applies, but they said, okay, we'll make taxes easier for you. So we'll just take away the deductions altogether. That makes it easier. Well, I'm sure you didn't mind answering a few questions in TurboTax to file your return electronically. Who uses a postcard anyway with a pencil and paper? So that was a bit disingenuous, but no sense editorializing right now. Let's stick to the facts. Miscellaneous itemized deductions are a big category, folks. I have a blog post about this. And this 2 pages of these deductions, all your unreimbursed employee business expenses, your tax compliance fees, your investment expenses, but there's a whole long list of all the things that you had as an employee, as an investor, that you were used to deducting that were peculiar to your industry that are now gone for the most part. Now, investment expenses, that's the big one I want to focus on today. That includes trading expenses when the trader is not eligible for trader tax status, TTS. Remember, trader tax status when you're in the business of trading, that gets you out of this so-called miscellaneous itemized deductions because you're allowed to go above the line from gross income. You're allowed to have a business expense on a Schedule C sole proprietorship or through a partnership or S-Corp. Other investment expenses include your stock borrow fees. So if you're shorting and related costs for short selling. So if you're going short now, if the market's correct or they're volatile and you borrow stock to sell short, those stock borrow fees you pay the broker. If you don't have trader tax status, those are investment expenses. You got to kiss that deduction goodbye. You don't get that. That hurts. Now, suppose you engage an outside investment advisor or a registered investment advisor where you spend X% of the funds under management or pay management fees and or incentive fees and related expenses. All those are non-deductible. Now, TTS, trader tax status traders have business expense treatment. That makes qualification for TTS more essential in 2018 than it's ever been before. It was always essential, but now it's even more essential. Consider the case of a family office, which refers to a wealthy family with substantial investments across multiple asset classes. The family office hires staff, leases office space, and purchases computers and other fixed assets for investment operations. Similar to an at-home trader, you might have a home office, you might have some people who help you out. You buy computers, you have other fixed assets and equipment, you have home office. The family office produces investment income, and the majority of its operating costs are investment expenses. Losing the investment expense deduction comes as a shock to family offices. So some of them are evaluating which activities might qualify for business expense treatment to convert non-deductible investment expenses into business deductions from gross income. They're contacting me saying, Bob, how can I qualify for trader tax status? I invest in securities in 1256 contracts. Can I ring fence them into an active trading program in a separate TTS entity so I then can allocate some of my overhead and costs to that business for business expense treatment so that otherwise I take more of it out of the so-called non-deductible category? Now, some family offices have other business activities like rental real estate, and they can allocate some of the expenses to that as well. Now, investment interest expenses are retained. That's different from investment expense. Under present law, the itemizing of investment interest expense remains. It's deductible up to the extent of investment income. The excess is carried over to the subsequent tax year. So you use Form 4952, you put down your margin interest, your investment interest. You then put down all your investment income. It pulls from your tax return, which can include long-term capital gains too if you elect, and short-term capital gains, of course, dividends, interest, portfolio income. So let's say you have 10,000 of margin interest and you had losses trading and your portfolio income was 9,000. Well, you'll deduct 9,000 on Schedule A. That's unchanged in the new tax law. And the other 1,000 that you could not deduct carries over to 2019 when you might have sufficient investment income. Now, remember I said short sellers have a problem. If a short seller does not qualify for trader tax status, the stock borrow fees are considered investment expenses. Watch out. Some brokers use the term interest charges when in reality, these expenses are stock borrow fees. Interest is only margin interest. You have to have an outstanding loan, promissory note of some kind, and paying interest on it. A broker can't just say, well, I want to call these borrow fees interest expense. They can't just do that. If they do, you have to treat it as an investment expense, and you cannot deduct it unless you have trader tax status. So read my blog post about short selling, how to deduct stock borrow fees, and I have a related blog post as well. And short selling may get bigger again as markets are very volatile if it continues along that vein. Interest expense rules were modified, not suspended, they were modified, but this should for the most part not affect the smaller trader. TTS traders have business interest deductions for margin interest on TTS trading positions. They don't have an itemized deduction. They don't need the Form 4952 with the portfolio income. They're flat out deducting all their margin interest on Schedule C or a partnership or S-Corp tax return. Now, the non-active spouse of a spousal partnership gets all your business deductions and Section 475 MTM, but the one thing they don't get is they are stuck with investment interest expense. So if you have significant margin, you may want a non-active spouse to have less ownership so that they get smaller allocation. That's usually not an issue though with our clients. And again, if it is, you just have the spouse own a lower percentage, like 1% or 10%, to mitigate it. So according to the new law, the conference agreement follows the House in exempting from the limitation taxpayers with average annual gross receipts for the taxable year, three taxable year period ending with the prior taxable year that do not exceed 25 million. Boy, their writing is not easy to read. Basically, if you're a small company, there is no limitation on interest, but if you're a big company, they want to limit it to 30% of your income. So they don't want a big private equity fund loading up their underlying companies with tons of debt, getting over the 30% and deducting it. They want to put the brakes on interest and accelerate dividends, moving away from debt. And they're giving full expensing, so they don't want you to double dip, full expensing plus leverage, being heavily leveraged. So this should, for the most part, not really affect trading companies. Now, carried interest was modified for managers. There was a big uproar over the last decade, and all the media wrote about it, and a lot of Warren Buffett and others threw carried interest under the bus, saying that, hey, why should the Warren Buffett and hedge fund billionaires and private equity billionaires have a lower tax rate than their secretary? Because the long-term capital gains rate is 20% plus the Obamacare 3.8% net investment income tax. But they focused on the 20% or the 15% rate versus ordinary rates of for 2017 of 39.6. So, about half. Why should a hedge fund manager get tax rates, half the rate of their secretaries. Well, the way it works is that if what's good for the goose is good for the gander, so if the investor gets a long-term capital gains rate, then the manager gets it because the manager is getting 20% of whatever the investor gets, a profit allocation. Hedge fund managers and private equity firms are not the only ones getting sweat equity long-term capital gains. What about all of Silicon Valley, all of corporate America that get stock options, that get stock, that get restricted stock interest? They're getting sweat equity type benefits and long-term capital gains too after they exercise options. Anyway, no sense editorializing. They did modify the rules. They did not repeal them. They did not say no more carried interest for managers. So what they did do is they said, listen, if you want the long-term rate, you got to wait 3 years, not 1 year. That's a much longer time. So a private equity deal, they got to wait 3 years rather than 1, and they do that. But a hedge fund usually doesn't wait 3 years. They may not be a day trading fund, and they may defer gains at year end and wait a year and get some long-term capital gains and a lot of short-term as well. So the new law changed the carried interest tax break for investment managers and investment partnerships, lengthening their holding period on profit allocation of long-term gains to 3 years from 1 year. The 3-year rule only applies to investment managers' profit allocation, the carried interest. If the manager also has a capital interest, it doesn't apply to that. It's for money they have in the fund. Now, this is what's really unique about the change they made and what's smart about it. They didn't mess with it for investors. Had they repealed carried interest, there was a nasty surprise that would have hit investors and really upset the investment management industry. And I don't think you want to do that if it's teetering on potential correction. So investors still have the long-term capital gain based on 1 year, but here's how carried interest helps investors. Had the new tax law repealed carried interest outright, investment partnerships without trader tax status, and most of them don't have trader tax status, they would be stuck passing investment advisory fees, incentive fees, through on Schedule K-1 as non-deductible investment expenses. Well, carried interest fixes that. The partnership allocates capital gains to the investment manager instead of paying incentive fees. The investor winds up with a lower capital gain amount versus a higher capital gain coupled with a non-deductible expense. Here's an example. The investor, his share of capital gains is $100,000. The hedge fund made $1 million, and each investor gets $100,000. And also, they pay 20% advisory fees, incentive fees to the manager. That was before the $1 million. So picture it this way. The K-1 says, here's your $100,000 capital gain. Pick that up on your tax return. And here's a $20,000 investment expense, which you cannot deduct. So the investor has to pay taxes on $100,000. The effect of carried interest is, for the most part, is that instead of passing through $100,000, you say 100 minus the 20 profit allocation. So you're carving out the carried interest, the 20,000 capital gains that you're giving to the investment manager, and you're telling the investor, here's your K-1 with 80,000 of capital gains, and that's what they pay taxes on. So in effect, the investor got the $20,000 deduction. So carried interest is really important for investors. So before you throw it under the bus, realize that. Next topic. First in, first out is still allowed, is still not required. There are other accounting methods you can use. The tax bills before there were law threatened to require first in, first out. So if you bought Apple over the last 10 years and you sold it, you could tell your broker, listen, when you sell Apple, sell the one I bought last at the highest cost basis, so my capital gain is lower. And Congress was threatening to withdraw that right and force you into FIFO, which would have beefed up people's capital gains a lot and really hurt. There was tremendous blowback. And that never survived the final tax law negotiations in the conference. So you can use specific identification, but remember, you have to contemporaneously write your broker and say, when you sell, I want you to sell 100 shares of Apple, but the one I bought on this date for this price. And they have to write you back saying that that's what they did, because otherwise you haven't complied with the specific identification rules for securities. And those rules may not apply to other instruments. For example, cryptocurrency, they probably don't apply to cryptocurrency. So yes, you have more leeway, but you need to contemporaneously execute to take advantage of that. Otherwise, a lot of active traders wind up probably using FIFO anyway. The trade log software we uses FIFO. Now, the tax law kept the long-term capital gains rate difference and retained the brackets, same as 017. So if you're in the lowest bracket, it's 0%. Let's say you leave a job, you have no income at all, and you're sitting on some long-term capital gains. You want to take enough capital gains to soak up that bracket, let's say 37,000 single or 77,000 married. You want to do some long-term capital gain selling at year-end, not tax loss selling, gain selling, because it's going to be a 0% rate. Now, once you go above that bracket, you have to pay 15% on all your capital gains. It's not like the first 77,000 worth of 0%. It all gets 15%. And then when you're in the top 37% ordinary bracket, then the 20% capital gains bracket applies. So those are unchanged. Remember, your long-term capital gains rates apply if an investor holds a security for more than 12 months before sale or exchange. The new law did not change the small 3,000 capital loss limitation against other income. It's never been indexed for inflation. And it did not change the rule about capital loss carryovers to subsequent tax years. They did get rid of NOL, net operating loss carrybacks for 018, not 017, and force you into carry forwards. And they have excess losses that are limited. So they did a lot to rein in the use of losses and make them forward-looking. But capital losses were always forward-looking anyway, except that Section 1256, like futures loss, which has a 3-year carryback election. So the new law retains long-term capital gains rates on qualified dividends. If you own common stock and hold it for 60 days and get a dividend, you use these so-called long-term rates, which are about half the size of the other rates, give or take at the different brackets. So these are meaningful benefits. Now, the new law didn't touch Section 1256, which is great. Those benefits are retained. So if you trade futures, broad-based indexes, options on futures, options on broad-based indexes, non-equity options, you have section regulated futures contracts in the U.S. A lot of foreign futures don't get this, but some do if they have a revenue ruling. Well, then you know 1256 has these incredible tax breaks. 60-40, 60% is a long-term capital gain, even if it's on a day trade. 40% is short-term. So when you do the math, the 60-40 math, instead of having a top rate of 37% for 018, the blended top rate is 26.8%, which is 10.2% less. That's a great benefit. Whether you have trader tax status or not, whether you have an entity or not, whether you're active, non-active, broker, investment manager, whatever. If you have 1256 contracts, you're getting these lower tax rates. You're getting that 3-year loss carryback election. But it's mark to market at year end. You're paying taxes on realized and unrealized gains and losses. Remember, with securities, it's realized only. It's the realization method. You can defer gains at year end and do tax loss selling through realized losses. With 1256 contracts, it's all mark to market daily and at year end. It's nice that the new law does not mention any changes to 1256, including no mention of getting rid of the 1256 loss carryback election. They probably just didn't even realize to get rid of that. The new law leaves wash sale loss rules in 475 untouched as well. It did not fix the wash sale loss rules that have been a real scourge to traders. If you take a loss on a security and buy back a substantially identical position, that same symbol or an option on that symbol at a different expiration date. So Apple December options, Apple January options, they're all substantially identical. If you take a loss and 30 days before or after, get back into that same substantially identical position, the IRS says, that's not an economic loss. We don't want it to be a tax loss. We're going to make you defer the loss and add the loss to the replacement position's cost basis. And if the replacement position happens to be in an IRA, including a Roth IRA, you're going to be disenfranchised from that loss permanently because there's no way to record that deferred cost basis in the IRA, not a 401k, but an IRA or Roth IRA, you or your spouse, if you file jointly. This is a real problem for traders because your 1099B only calculates wash sales based on identical positions, the same symbol, not between equities and options. And the broker only reports it based on the one account. That's the rules the IRS asks brokers to follow. The brokers are not incorrect. They're exactly correct. They're following broker rules. In a dumbfounded manner, the IRS has separate rules for taxpayers, and I don't know how they expect for you to comply with it without using complicated software, which like TradeLog, and we use it in our trade accounting service, where you can download your trades from different brokerage accounts, including IRAs, and do it correctly, but it's extra work. Why should you have to go through that extra work? Why should you then depart from the 1099B? That should have been fixed. It would have made taxes much simpler. It was a huge problem. I asked them to fix it, and they did not fix it. So you're still stuck with the wash sale loss problems. Remember, you get your 1099B now from Lightspeed, and let's say you see proceeds, you see cost basis, and let's say you see wash sale loss disallowance of $50,000. But you got out of all your positions in December. You went to cash by year end. If you had a wash sale loss in a few different symbols, you made sure you didn't get back into it within 30 days in January, and you know that you don't have any wash sales. Well, you probably can just use that 1099B. You don't have a $50,000 wash sale year end. Yes, you have a $50,000 wash sale loss adjustment during the year, but what you don't understand is that the 1099B also put the wash sale loss adjustment into the cost basis. So $5 million of proceeds minus $4,900,000 of cost basis equals $100,000 gain. That $50,000 of wash sales that you had is in the cost basis number 2. So think it out. It probably all makes sense. You're just getting thrown for a loop when you look and fixate on the wash sale loss number. But if you get lost and you have multiple accounts and you have equities, you have options, then you want TradeLog or our trade accounting service. You got to get your numbers right. You got to be confident in your gain or loss numbers. And you got to deal with the wash sale properly as well. I cover all this in Green's 2018 Trader Tax Guide. There are some prior recordings and free content on our website in the Tax Center as well. So check all that out. That's beyond the scope of today's session. But all this is unchanged in the Act, so you're still going to have these headaches in 2018. Now, your ticket out of wash sales treatment is a 475 election if you're a trader tax status trader. You have to elect it by April 17th, 2018 for 2018. It's retroactive to January 1st, so this way won't have a wash sale problem this year. If you have trader tax status in 2017 and open positions, the TradeLog software will do the 481A adjustment for you, converting the wash sales to an ordinary loss. Got to get the accounting right, folks. Switching from cash to 475. The 475 rules are unchanged. That's still a gold mine for our clients. It's your ticket. It's always been tax loss insurance on the downside, exemption from wash sales, Exemption from the capital loss limitation, a big ordinary loss deduction, get that huge refund, tax loss insurance. Now with the new tax law, there's a benefit to 475 on the upside. If you need 475 income to get that 20% pass-through deduction, capital gains are excluded from qualified business income that you need for the pass-through deduction. Trader tax status is better than ever. 475 is better than ever. There's tax loss insurance and an income tax deduction on gains. Now, the new tax law also does not change tax treatment for various financial products, including spot forex and 988, ETFs, ETNs, that's your exchange traded notes like your volatility ETNs, your volatility options, precious metals, swap contracts, foreign futures, all that's untouched with the tax law. So you can stick with our content from prior years for the current year. They also did not do anything to repeal the Obamacare net investment tax. Even when Congress was talking about repealing Obamacare, they weren't going to repeal this net investment tax. It's retained. The new law retained the Obamacare net investment tax NIT of 3.8%, the Medicare surtax on net investment income over modified AGI of 200K single, 250K married, not indexed for inflation. So let's say you're single, you make 300,000. You're 100,000 over the 200 modified AGI. Of that 100,000 that you're over, 80,000 of it happens to come from net investment income after net investment deductions. Well, you're going to pay the 3.8% on that 80,000. Ouch. The act, now this is something a lot of your local accountant may miss. You remember I told you for 018 that your investment expenses are suspended? That's for your regular tax. They suspended miscellaneous itemized deductions, period. Took them one sentence to wipe out a whole bunch of deductions. Well, that happens to be an itemized deduction. They didn't say that they were getting rid of that deduction for purposes of net investment income, so you can still deduct it there. Now, maybe it was an oversight and they'll come out with a technical correction, but until they do, we're going to deduct it from net investment income. So remember I said it was 80,000? Well, you can apply your state and local, your miscellaneous investments, a whole bunch of deductions here and get it down to 70,000. Save 10,000 times 3.8%. It's a little savings, worth something. Now, your ordinary tax rates are reduced across the board. That's one of the main benefits of tax reform. Yes, they got rid of a bunch of deductions. They added that new pass-through deduction. But the key is that they lowered rates for individuals and corporations. Don't underestimate the power of that. When you see the result, there is benefit there. So they lowered all the brackets. It's meaningful. For example, the top rate was lowered from 39.6 to 37%. So when you look at the brackets, there's some nice savings there. Short-term capital gains are taxed at ordinary rates. So just Google 2018 tax rates. You'll see the brackets. You'll see the rates. There are articles showing you the difference from 017. And Google your state and you'll see your state rates. That's the easiest way to manage your rates. Traders always ask me, how much do I owe? And I say, look at the brackets. Now, another nice benefit that you have for 2017 that you can kiss goodbye for 2018 is the repeal of the recharacterization option for Roth IRA conversions. If a 2017 converted Roth account drops significantly in value in 2018, a taxpayer can reverse the Roth conversion with a recharacterization by the due date of the tax return, including extensions October 15, 2018. That's the last year to do a reversal. The new law repeals this recharacterization option starting in 2018. So let's say in December 2017, you were one of our clients, you came to us, you had no income. You wanted to use your itemized deductions. They were wasted. And you had some trading losses, maybe with 475, and you didn't want to do an NOL carryback. So you did a Roth conversion, or you did a Roth conversion to take advantage of low rates. You had money in your IRA, which is temporarily tax-free. When you take distributions in retirement, which you must start doing required minimum distributions by age 70 and a half. Those are taxable, and tax rates could be higher by the time you retire. Who knows what administration will be in office and what's going on in the U.S. And you're going to be paying taxes. If you get that money into a Roth, which I think is great for traders who can make good money from what's in there, all the growth is permanently tax-free when you take the money out in retirement, and you don't have to take any required minimum distributions. You can pass on these benefits to your children. They will have required minimum distributions, but it will be permanently tax-free. So that's a great benefit. Well, a lot of people can't get enough money into a Roth, so they want to convert from a regular IRA. So let's say you did the conversion in December 2017, and the account dropped a lot in 2018. Let's say that there's some sort of major correction, and it drops a lot. Well, for 2017 conversions, you can just reverse it like it never happened, but you can't do that in 2018 conversions. So keep that in mind when you consider a conversion. Let's just break for a second. Okay, let's talk about pass-throughs, that deduction. The new tax law section 199A allows a 20% deduction on qualified business income in pass-through entities, subject to many conditions, haircuts, and thresholds. The new tax law says an individual taxpayer generally may deduct 20% of qualified business income from a partnership, S corporation, or sole proprietorship, as well as 20% of aggregate qualified REIT dividends, qualified cooperative dividends, qualified publicly traded partnership income. A limitation based on W-2 wages paid is phased in above a threshold amount of taxable income. A disallowance of the deduction with respect to specified service trades or businesses phased in. Very confusing, right, folks? Let me tell you the long and short of it to go off the slides. If you're a service company, you're going to be limited very quickly if you make too much money. If you get over the income threshold of $315K married or $157,500 for other taxpayers, you're going to be phased out at $100,000 over that or $50,000 over that for other taxpayers. So let's say you're single, you're a trader. It's a service business, so you're not getting the break like a manufacturer. It's based on your taxable income, not the company, not anything else, or a hedge fund. It's your taxable income. If you have a job where you make $150,000 and you're single, and your trading gains are $50,000, now you're up to $200,000, and you take a standard deduction, and your taxable income is over $157,500, you're going to be phased out at up to $50,000 above that. So if you make over $207,500, so you're single, your taxable income for 2018 is going to be over $207,500. You're not going to get this 20% QBI deduction. So it's not for you. Now, if you're married, you might want to married filing separate and see how it works out. Now, if you go over the $157,500, the phase out applies. So there's $50,000. If you use up 40 of that $50,000 phase out, you lose 80% of the benefit. So it phases out in a logical manner. Now, you might invest in a hedge fund, and a lot of investors, a hedge fund with trader tax status in 475, a lot of investors are over the threshold, income threshold. They don't get a deduction, but some could be under and they get a deduction. Now, it doesn't matter whether you're active, non-active, or passive. Now, if you're a non-service company, now trading is a service company, investment management is a service company, a hedge fund is a service company. If you're a non-service company like a retail store or a restaurant or a manufacturing operation, yes, your income can be over the income threshold. Now, if it's under, you get the deduction. There's no other. That income threshold's across the board. The 157.5 for other taxpayers and 315K, which is double that for married. If you're under that threshold, whether you're service or non-service, you're going to get the deduction without any other limitations. It's as simple as that. If you go over the threshold, then you say to yourself, if I'm service, I get nothing. But if I'm non-service, I can get something, but the wage limitation applies. There's a 50% wage limitation for that underlying company. So let's say you're invested in your cousin's pizza shop, and they happen to have a bunch of wages. Well, the income that was passed to you is $50,000, and the wages that were passed to you are $25,000. Well, you don't get 20% of $50,000. You're going to have the 50% wage limitation apply, which will be less. So there's haircuts everywhere you look. Now, real estate companies balked at this. So when they were negotiating the final deal, they said, listen, we don't have wages. We're going to get nothing. So they passed an alternative 25% wage limitation plus 2.5% of qualified property. So this is very confusing. You need to say to yourself, what businesses am I invested in? Across the board, whether I'm active, non-active, Schedule C, partnership, S-Corp, what am I invested in? Let me look at myself first. What do I think my taxable income is going to be for 2018? Now, this deduction happens to be on the qualified business income, and each one of those businesses all added up, or the lower of taxable income less capital gains. It's another haircut. So first you want to see, where do you stand? Are you under this overall income threshold or not? If you know that you and your spouse have big income outside of these investments and you're over the threshold, then you're saying to yourself, forget the service activities, I'm getting nothing. Let me look at the non-service activities, and do they have sufficient wages for the wage limitation or the qualified property alternative? And, you know, the way I would look at it is it's all going to be icing on the cake. I wouldn't make an investment because you're counting on these deductions, because so much will be left to the year end to see how it works out. So I would do what you have to do, and this deduction is the icing on the cake. So this is what I think you as a trader should do. So now maybe you got a little lost in the weeds of the last few minutes, but now focus on what I think you should do as a trading company. If you have trader tax status, 4 trades a day, 4 days a week, 15 trades a week, 60 a month, 720 a year, frequency is 75% of available trading days, holding period under 31 days, 4 hours a day. You know the drill. You can see it on our website for the eligibility for trader tax status. If you have it, this is what I want you to do. Pay attention now. For 2018, trader tax status traders should consider a partnership or S-Corp for business expenses and a 475 election on securities for the exemption from the wash sale loss rules and the ordinary loss treatment to tax loss insurance, the exemption from the 3,000 capital loss limitation. Without focusing on the 20% deduction yet, let's talk about the cake first, the main strategy. The partnership or S-Corp, trader tax status for the business expenses and 475. And if you need employee benefit plan deductions, including health insurance and a high deductible retirement plan, then you should consider the S-Corp, because a partnership return or a sole proprietor Schedule C cannot achieve employee benefit plan deductions. And I explain that in the guide. So if you don't need the employee benefits, you got the partnership. If you need the employee benefits, you got the S-Corp. That is the cake. That was what worked for 2017 and prior years, and that still works great for 2018. And it puts you into position to potentially qualify for the 20% QBI deduction, pass-through deduction, on the 475 income, which is QBI or 4X Section 988 ordinary income, in the pass-through entity. And that's the icing on the cake. So I want you to go for the cake. If you hit a home run and you price yourself out of the icing on the cake because you made too much money and the icing is too much sugar, the IRS doesn't want to double dip you, give you too much benefit, okay, you don't get the icing on the cake. All you need is the cake. You get a high deductible retirement plan, You max out the solo 401k. You go for the 61,000 if you're age 50 or over, or 55,000, or a defined benefit plan for 150,000 plus or more. That's what you go for if you price yourself out of the 20% QBI deduction. If you didn't hit a home run and you didn't have a great year, then you'll get the icing on the cake with the 20% QBI deduction. That's how I think you should approach this pass-through deduction. So remember, you're a service business as a trading company, and you need qualified business income, which likely includes the 475 income, and it likely excludes the business-related capital gains. Now, the law specifically says investment-related, all capital gains are excluded. So we think that probably means business-related capital gains too. They didn't specifically mention 475 ordinary income, but ordinary income is ordinary income. There is no such thing as business income. In this blog post, I explain how traders can get the 20% QBI deduction under the new law. I lay out all the rationale, so read those posts. Now, it might be a challenge for a TTS sole proprietor trader to claim the pass-through deduction because Schedule C has trading expenses only. Maybe you transfer some trading gains to Schedule C to zero it out, so it's less of a red flag. I explained that in my guide. But there's no trading gains on Schedule C, and the IRS may not accept this Form 4797. My partner, Darren Neuschwander, head of tax compliance, says he's much more comfortable with the trader using a partnership or S-Corp return because then the ordinary income is on page 1 of the 1065 or 1120S. It looks like any other ordinary business income, and it should go through more smoothly. So that's why I want you thinking about the partnership or the S-Corp. Now, let's talk about the C-Corp. Maybe you think that's for you. And 1 second, take a quick water break. How should you decide if a C-Corp is right for your trading business? When taking into account the new law, don't focus solely on the new 21% flat tax rate. That sounds great. But remember, it's a flat rate. In the past, you got 15% on the first 50,000. Some C-Corps were close to break even every year and got to that 15% rate. They're having a tax hike. It's a flat 21% rate. Your individual rate, if you're not making a lot of money, it could be under 21% or close to 21%. There are plenty of other taxes to consider, including capital gains taxes on qualified dividends, state corporate taxes in 44 states, IRS accumulated earnings tax of 20% if you keep too much money in the entity, the C-Corp, and potentially a personal holding company tax. By the time you add it all up, the C-Corp and related taxes might be considerably higher versus trading in a pass-through. Remember, with a C-Corp, it pays taxes on the entity level and a second time on the individual level, the double taxation. When a C-Corp pays qualified dividends to the owner, double taxation occurs. So if you need to take money out of the entity to pay living expenses, you're going to be triggering the qualified dividends capital gains taxes, which you can use those lower long-term rates if you hold the stock for 60 days or more, which you will because you'll wait until year end, or you'll wait 60 days for the distributions. And those rates are 0, 15, and 20%. But 21% plus 15% is 36%. That could be higher than your individual rate with the double taxation. Plus, if you get hit with that 20% accumulated earnings tax, it's it's a game changer. It makes the C-Corp much worse. It's a fallacy to think that you can retain all the earnings inside the C-Corp. The IRS only allows you to keep $250,000 or $150,000 if you're a personal service corp. And if you're an investment company in their eyes without trader tax status, and we don't know if they'll respect trader tax status in a C-Corp, if they classify you as an investment company, game over. They will hit you with a 20% accumulated earnings tax for all earnings and profits that you leave in the C-Corp, on top of the 21% corporate rate. And then you still could have double taxation. Don't jump into the C-Corp without learning how it works, on how the qualified dividends work, how the state double taxation works, because In 44 states, there are state corporate tax rates of 3% in North Carolina to 12% in Iowa. I give you a map to see what the rates are in your state. Plus, when you pay the qualified dividends, you don't get a lower rate on the state level. They treat all income the same. So double taxation can really add up on you. Now, go and read that blog. You'll fill in the blanks on it. Now, next and last section. Many individual deductions are suspended or trimmed, and that feels like a lot of pain for taxpayers, like the state and local taxes. They're capped at $10,000. Any combination, state and local income, sales, domestic property tax, meaning U.S., your foreign real property taxes don't count. So any combination of adding it up, you can take a deduction for it. Now, if you have a home office deduction, you can get some more onto the home office area. That's another way to get more salt. You couldn't just prepay 018 and 017. The IRS said you cannot pay income taxes for the next year and get the deduction this year. They also limited how you could do it with real property. You had to have a real property bill from your town or city saying this is what you owe from July 2017 to June 2018, and they gave you the option to pay the whole year. You couldn't just take it on yourself to pay all of 2018, so you're not getting that deduction in 017. Don't try to do that. And you are going to be limited in 2018, but not for your net investment tax, not for your home office deduction. And some states may recharacterize it as charity or employment taxes or something else. So give your state a chance to come up with a solution, which the IRS may fight them out on. A lot of traders are moving out of high tax states. They're very upset about it, and they're moving to Florida or Texas from California or New York. So talk to us about it. So again, if you have a home office deduction as a TTS trader, first report the real property taxes on that schedule, not income taxes, the real property taxes, and then the balance goes on Schedule A. Now, your mortgage debt was lowered on new loans. As of December 15th, new acquisition indebtedness is limited to $750,000, half it if you're married filing separately. That's down from $1 million. On a primary residence and second home, they kept both. They threatened to get rid of the second home, but they kept that. Now, mortgage debt incurred before 12/15 is grandfathered. So if you're afterwards, if you're refinancing old debt, you could still have the grandfather. Like if you had $1 million mortgage and you're refinancing that, but if you're increasing it, you're going to be subject to the new limits. So read my blog post where I fill in some more of the details. They did get rid of the home office deduction. So if you had a home office where you could use to write off interest on up to $100,000, kiss that goodbye. That's gone for 2018. Now, charity remains a deduction, along with the cap 10,000 SALT and along with the reduced mortgage. And the standard deduction is increased. So you got to see, what are you using the standard or are you using the itemized? You got to take a closer look at that. They raised the 50% limitation on cash contributions to 60%. So if you give a lot to charity, like some of the billionaires do, they raised the limitation. Now, with a higher standard deduction and suspension of many itemized deductions, some taxpayers won't feel the benefit. So you may see for 2018, if your standard deduction is $24,000 and your SALT is capped at 10, and you don't have a big mortgage, especially after the home office deduction, and you no more miscellaneous itemized deductions, your charity may not be enough to get you into an itemized area. So you may feel, hey, I don't need to give extra money to charity this year. So consider a bunching strategy. Give enough to charity in 018, double, triple up, get the itemized deduction, and then give less in the following year. Charities have to plan for that. Now, what some traders are doing is as another bunching strategy is considering a charitable trust. You open up a charitable trust for $50,000. You invest it. You can't trade it. That money's gone. You can't take it back. It's going to charity. You get a deduction in 018 for the whole amount you contribute to the trust, and then you piece it out over the next few years to charity. So at least you got the deduction up front in 018. So let's look at some closing remarks and go to questions on the board. So you want to come back to greentradertax.com and you want to give us a call, 888-558-5257 or 203-456-1537. Email questions over to info@greentradertax.com. So let's go to the website, and then I'm going to bring up questions on the board now. And we'll go a few minutes for questions. Hopefully I see those. And Joe, I don't see the questions because I'm not an organizer. You have me as a presenter, so I don't see the questions. If you want to quickly make me an organizer, hopefully I can see them after the fact.
I'm not sure how to make you an organizer.
Just right-click me on attendees, and it should see the option to make organizer under staff, unless you don't want to mess with it. People can email me questions at the info at greentradertax.com.
I can post the questions in the chat. Can you see the chat?
Yeah, go ahead.
All right. Of course, it's not letting me copy them. When I right-click on you, there's no option to make you
organizer.
Oh, make organizer. Look at that.
Right.
I think I found it. How's that?
So now I see questions. So stay with us, everybody. We're going to answer some questions. Joe, how long do you want to go? We're an hour for the content, and how long do you want to go on the questions?
Whatever you think is.
Let's do like 15 minutes or something. Let's get your questions on the board. Keep it on topic. And all right, so let's get started here. So Bob D, I'm only going to give it last name initials. Bob D, the people are interested in the slides. I think, Joe, you're going to have a recording after, right? And you can have the slides.
Yes.
You can use the slides too if you want, Joe.
Yes, they'll be recorded.
All right. Okay, so John S., when do we have to set up the S-Corp? Well, now's a good time to do it. Your trading year to date would be individual. But once you have the entity, and you may have to pay higher professional data feed fees with Lightspeed, but they have such low commissions for an entity account. But your entity you'll have an entity account, and it will be for the rest of the year. So your year-to-date trading might be capital gains or losses, and maybe you'll elect 475 in the entity, and then you'll make enough money in the entity for the pass-through deduction and for the employee benefit plan deductions. That health insurance deduction is huge, and there's no offsetting payroll tax. So you really need the S-Corp for that, and it's a great thing to have because health insurance is expensive now. The sole proprietor trader does not have earned income to deduct that. We have other content on the entities to help you along on our website, recordings, and it's in the guide. Next question from Helmut R. Will there be a webinar also for individual day trading addressing tax advising for other matters? Well, yeah, there's plenty of not necessarily through Lightspeed. I usually do one a year for Lightspeed, but come over to our website. There are some other recordings and other content and the guide. And other people made nice comments. Thank you. Philip W. In 2015, I was approved by the IRS for 475. Do I have to reapply in subsequent years? No. Once you make a proper election for 475, like let's say that you elected on time for a prior year, 2015, and you've been using it every year since, you must use it if you have trader tax status. If in a given year you don't qualify for trader tax status, then you may not use it, but it's suspended. It's held in abeyance until you requalify for trader tax status. Unless you revoke the election, which you can do by April 15th of a given year, in which case you can't re-elect it for 5 years. So we have a lot of information on 475. It's chapter 2 of our guide. It's important to understand all the reasons to use it, the good reasons, the nuances, the misconceptions. Some people don't elect it because they think it applies to futures and they lose 60-40, which is wrong. You can elect it on securities only. You can still have long-term investments with long-term capital gains that are segregated. You can have your cake and eat it too with 475. Next question from Eric F. What is the tax rate for a TTS trader It's the same tax rate for anyone else, whether it's Section 475 ordinary income or short-term capital gains tax at ordinary rates. Whatever your marginal rates are is your marginal rates. Remember that with graduated rates, you're getting the benefit of lower rates at your lower income. You don't pay the top rate on everything. You only pay it on, for the ordinary rates, you only pay it on the marginal income. With the long-term rates, you pay it on everything. So the next question, one second. So ML, Miko L, is the 2018 Green Trader Tax Guide updated for the recent changes? Yes, absolutely. The whole guide is updated for the new law. I put a lot of work into it, and it was released in January 15th. I would definitely get the guide. It's really important this year. It's materially different from last year. I put a lot of the same areas, same information too, but I would say it's about 50% new. John H., do you have to file for TTS with 1040 filing, or should I file it now? This is where some confusion kicks in, John. As you look at your 2017 tax preparation, which I know Lightspeed wanted me to help you with today, trader tax status is like you pull the bread out of the oven at year end. If it rose to the level of trader tax status, you claim it, you add a Schedule C, you deduct all your trading business expenses. You're still stuck with your capital gain or loss treatment and wash sales unless you also elected mark-to-market accounting by April 18th, 2017 for 2017. So trader tax status is like undergraduate school, and 475 is like grad school. You need trader tax status to elect 475, but you don't necessarily have to elect 475. For example, if you have a large capital loss carryover, you don't want to elect 475 right away. You want capital gains to use up your capital loss carryover. You don't want mark-to-market ordinary income, which could not use up your capital loss carryover. Lois P., if we sell a stock for a tax loss harvesting and sell an out-of-the-money put, well, this will get confusing on the wash sale loss rules, but remember, your broker doesn't pick up wash sales between options and equities, but you do. Whatever kind of option you get into, it is a substantially identical position with the stock, so that probably is a wash sale. Lois, but you'd want to get to us with your exact question, and you can send me more questions after this. I might give you a quick little answer, but I probably will recommend a consultation with me, a paid consultation on our website. That's what I spend most of my days doing. Lois P., does Lightspeed do the wash sale in the accounting? Remember, all brokers have wash sale loss adjustments based on IRS rules for brokers, only on identical symbols per the one account, not on substantially identical positions across all accounts. So read our coupon on that. Rob F., there's no coupon for the guide. We don't have it discounted. It's at full price, but believe me, just one page is going to make it worthwhile for you. It's really worth it. It's an excellent product, and will save you a lot of money. So do we have any more questions on the board? Otherwise, we're going to wrap up. I think I got to all the questions. I'm not going to give multiple ones, follow-up questions. You'll have to come back to me on that. Thank you all for your nice comments. I appreciate that as well. So again, let me show you quickly around the website a little bit while we'll wrap up for a minute. So you come over to the tax center here on the main page, and there's a whole drop-down menu. There's different types of traders, trader tax status, like tax treatment on financial products. This is a big area where you have securities, capital loss carryovers on the right here, and explore. You have Forex, cryptocurrency. This is a huge cryptocurrency tax guide. Forex, ETFs, options, everything. The wash sale stuff I was talking about, the cost basis reporting. So you definitely want to spend some time in that section. Spend some time in the trader tax section as well. We're on the right side. We have some information on the right side, the business expenses, the how to qualify, entity solutions. So you want to spend some time in the tax center. But you'll notice on the home page that we feature the blogs, like the recent one on the 20% QBI deduction, one on the C-Corps, one on the cryptocurrency. But on the sticky nav here on the right, you can look at all the blogs and look at the whole history, and there are good archives, categories. You can click a category, like for the tax cuts, and read all about that. And then take a look at all the events with lots of recordings. So you'll see there's plenty of recordings here. There's a whole bunch of those. So take a look at that. You're going to have questions, folks. We give you a lot of free content, but you're going to have questions. So consider a consultation. That's with me. I do that all day long. I don't work on the compliance tax preparation anymore because I'm too busy with consulting. So you'll read about how that works. You'll purchase 45 minutes, and then you'll get right access to my calendar and schedule that. And I'm almost done here. Our main service is tax compliance. We prepare your tax return. You start with a client evaluation. We assess whether we're a good fit. We give you a price estimate, an estimate of the benefits you're going to get working with us. That's for first-year clients only, and then you sign up we have a whole roster of CPAs who are fantastic. My partner, Darren Nussbaum, heads up this area of our practice. My other partner, Adam Manning, helps in doing so. They'll be the partners on your account. This is our core business. Why not have us do all this work for you? It's very complicated. But you can do things on your own too and use our content to do it. If you want an entity, first you need to consult with me, and then I form your entity and get you started up on all that. And you can use this for the accounting services too, to download, do all the wash sales right, do the coin trade accounting right. If you have troubles with the IRS, we can help. So that's our website, folks. That's today's session. It was great to have you here. If you're listening to the recording, I'm glad you did too. Thank you to Lightspeed. They're a great company. A lot of our clients use Lightspeed. Thank you, Joe, and back to you.
Oh, thank you so much. I really appreciate it. It's always a pleasure to have you speak for us. Very informative, very timely. A lot of people get a benefit out of it. For those that are interested, definitely check out the Green Trader Tax website. And if you are new to Lightspeed, check out our website, lightspeed.com. We can provide you with a real-time demo of our trading platform. Other than that, I think we'll wrap it up for the evening. I appreciate everyone's participation tonight, and thank you so much. Bye-bye.